Hello, my name is Dylan Marcella, and I'll be going over the ratio analysis for Hasbro and the toy industry. Before we begin the ratio analysis, I wanted to discuss a few key items on the income statement to get a better idea of where Hasbro is and where the industry is heading going forward. As you can see on the chart in the video, we have aggregate revenue, we have revenue growth, operating profit, operating growth, operating margin, net income, profit margin, and profit growth. So the most notable thing is in 2018, we see declining growth all around the board in revenue, operating profit, and net profit. So what happened that year? Well, one of their largest distributors, Toys R Us, went bankrupt. And this was a whole aggregate macro effect for the toy industry, not just Hasbro. Other companies were hurt more, as we can see as we'll see in the ratio analysis. Mattel was hurting a lot more than Hasbro hurt, but still Hasbro was damaged from this event. So what does this mean for the industry going forward? It means that we might see more e-commerce growth throughout the industry and more sales through Amazon. So in 2019, we see positive revenue growth, operating growth, and profit growth, which is a great sign and a great rebound for Hasbro. This is a good sign going forward, and we hope this trend will continue through their competitive advantage and releases of new movies and intellectual property licensing. To start the ratio analysis off, we're going to start by looking at 2018's numbers and solely comparing Hasbro and Mattel for a few reasons. The first reason is because we want to see what really happened during the shutdown of Toys R Us and how it affected the financial data. The second reason is because Spin Master is an Asian company, was not affected by the shutdown. The third reason is because Apple, Tencent, and Activision are all substitute competitors of Hasbro. And a lot of the direct competitors that compete with Hasbro in the respective markets are actually not publicly traded, so we cannot conduct this financial analysis. So we're going to solely be looking at the profitability in the industry and see what really happened. So we can see that Mattel's gross margin is 60% compared to Hasbro's 48%. This is due to the differentiating quality of each product. Mattel's products are known for being low quality and being sold at a cheaper price. Therefore, they're produced cheaper. Relative to Hasbro, known for their product innovation and high quality, it costs more to produce, therefore having a lower gross margin. It's surprising though because we can see that Hasbro has positive profit margin, return on asset, and return on equity, relative to Mattel where it was all negative. The final part of the ratio analysis will begin by looking at the profitability in the industry. We can see that Hasbro has the lowest gross margin as Mattel and Spin Master. This is due to their corporate strategy by being the innovative / highest quality in the market, and therefore their cost of goods sold will be higher, lowering the gross margin. Their gross margin is 47.08% relative to Mattel's 56.03% and Spin Master's 50.37% gross margin. The next is net profit margin, and we can see that Hasbro has the highest margin compared to Mattel and Spin Master, but lower relative to the tech companies Apple, Tencent, and Activision. This actually poses threat to Hasbro that these companies have much larger profit margins because they can reinvest the earnings into new and existing product lines that will compete against Hasbro's product lines, which could hurt them. It's also very important to note that since Hasbro has the largest profit margin of the direct competitors in the toy industry, it's exerting a competitive advantage because they're making more money relative to revenue than any other company in their industry. The next ratio is the return on asset ratio. This ratio is a measure of how good the company is at earning profits relative to their assets. It's interesting to see that though Hasbro had the lower asset turnover ratio, they actually have a higher return on asset than the companies in the industry, Mattel, and Spin Master, meaning they generate more revenue for their assets. And it's important also to notice about the negative profits in Mattel's income statement. They have a negative profit margin and a negative return on asset, which means the company is not earning any profits and are cash flow negative. The final measure to look at is return on equity, and this is the measure of how good the company is making investments, comparing net income to total stockholders' equity. And once again, Hasbro showing they are exerting their competitive advantage, earning a higher return on equity compared to Mattel and Spin Master. To take away from the ratio analysis, we can see that Hasbro has really been able to employ their competitive advantage better than any other company in the industry. This is shown by lower leverage ratios, being able to generate more money using less debt financing relative to their largest competitor, Mattel. Also, a higher working capital ratio, showing they generate more working capital and cash relative to the rest of the competitors. Another way to tell this is by the profitability ratio, the best sign of showing a competitive advantage. They have a higher profit margin, higher return on asset, and higher return on equity. To mention that Mattel, all of their profitability ratios are negative, therefore they're not earning any profits. Also, the increased leverage in the industry is not good for the companies, but Hasbro has been able to position themselves better than Mattel, simply because Mattel's debt-to-equity ratio is significantly larger than Hasbro's. With the coronavirus outbreak, companies that aren't earning profit and are using more leverage are posed to significantly more risk than companies that aren't. Though Hasbro does have debt financing, it's not as severe as Mattel's debt financing, which puts them in a better position in the industry. What really helped Hasbro during this year was them being able to employ their competitive advantage, specifically their intellectual property. They were able to produce Yoda baby dolls and be able to produce Avenger toys, which really sold well, primarily because of the release of Disney Plus really helped them sell more. Therefore, to conclude this, I would say that Hasbro is in a much better financial position relative to any direct competitor in the industry.